It's wonderful to be here. I appreciate you joining us. It's terrific to be back in Australia. It's terrific to be back traveling again, my first time back in Australia since 2019. And it's wonderful to see things getting back to normal. I have a presentation to share with you today. It's a long deck, but I'll go through it fairly quickly. And I think hopefully there'll be enough information there that you find useful and helpful as you think about the investment environment that we're in. And give you some sense both of how we at Epoch Investment Partners are thinking about the macro environment, and as well how that macro environment is one that we think is well suited for our global equity shareholder yield strategy. Now, the title page that you see here for our talk today, reflation, duration, and then what's going on, salvation, preservation. We're being perhaps a little bit too clever, but when we originally did this presentation and started to formulate this outlook, it was back in December. And our view then was that we thought interest rates were inflecting upward and the environment was changing, and that the environment that we would see for the next few years would be very different from the environment that we had experienced in the past few years. So reflation was occurring, duration, we'll talk about that. That's something that we've talked a lot about and done a lot of work on in our shop over the past 9 months or so. And then the salvation part, honestly, the view was that after a few years of being in a challenging situation in terms of relative performance with a strategy like this, focused on dividends, focused on income, when the rest of the world is focused on momentum and growth, it seemed like the wheel was turning, coming back our way. So the salvation part of the title was, for those of us who kept the faith, this was when things were going to come back our way. So it's 6 months later, 7 months later, and we've retitled the program for you a little bit here, Reflation, Duration, and Preservation. So now our thinking is the environment we're in is very challenging, and you'll see with some of the slides that I show you today, very challenging environment, an environment of slower growth, higher inflation, higher interest rates, a lot of uncertainty. It's an environment that's well suited for a defensive strategy like the shareholder yield strategy. So now what we're thinking about is the preservation. We want to be able to grow wealth, preserve wealth, and we think we can achieve that for investors with this strategy. So just, if you will, a minute on the firm, Epoch Investment Partners. This is a bit of a snapshot that shows basically we have a presence around the world. We have clients all across the world. We have a variety of clients, both institutional and retail. And the two pie charts you see on the right, that's a representation of our product shelf, if you will. We are a long-only equity shop. We have a variety of equity strategies. And you can see the shareholder yield strategy is really the biggest individual franchise that we have at Epoch Investment Partners. So this slide is one we call our 5 uses of cash model. It really is foundational. Foundational both for the firm's investment philosophy and as well for the shareholder yield strategy as an application of that philosophy. What we do at Epoch, we think about free cash flow investing. That's the key metric that we look at when we're evaluating companies for our portfolios. And we look at it through this lens. The idea here is there really are only 5 things that any company can do with the cash that it generates. It can invest to grow inorganically through mergers and acquisitions. It can invest to grow organically through capital expenditures and R&D spending. And on the other hand, the company can return cash to the owners of the business through dividends, share buybacks, and debt reduction, what we call shareholder yield. One of the things that we always say at Epoch is we're looking for companies that are good capital allocators. And what we mean by that is that companies understand the sources and uses of cash that we've outlined here, and they understand their job as stewards of the capital entrusted to them is to find opportunities to invest, earn a return above the cost of capital. And to the extent that they run out of wonderful ideas to earn a return above their cost of capital, it's their duty then to return the capital to the owners of the business through dividends, share buybacks, and debt reduction. Quick picture here of the team that's involved on the shareholder yield team. The best way to think of it is a team of 6. Kira Van Valen is the lead portfolio manager. I'm the co-portfolio manager. And we have 4 dedicated analysts who work with us exclusively on the shareholder yield strategy. So that's Michael Beckerman, Bethany Castor, Michael Jin, and Alex Orozco. The other two faces you see on that page are Mike Wellholter and Bill Priest. So Bill Priest is the co-founder of the firm, and he's one of the co-chief investment officers of the firm. And because he's the inventor of this strategy, he's the creator of the shareholder yield strategy, he is a named portfolio manager, but his day-to-day involvement is really very, very limited. He has a keen interest in the success of the strategy, but he's not telling us, here's what I think you should be buying or selling for the strategy. Mike Wellholter, on the other hand, is our chief risk officer. He's also one of the co-chief investment officers, and he worked closely with Bill back in 2005 when the shareholder yield strategy was being created and rolled out into the commercial marketplace. So he also is a named portfolio manager on the strategy, and it's a little bit of a thing at Epoch. Part of our philosophical approach, we want to make sure that risk management is closely integrated with investment management. So Mike, or one of the people that work for Mike, is a named portfolio manager on every strategy at Epoch. So that's the team. What I'd like to do for the next few slides is talk to you a little bit about the macro outlook and how we see things evolving in the months and quarters to come. And I'll start here with Ukraine. If you had asked any of us at Epoch, what's the outlook in January, or indeed up until February 23rd, what's the outlook that we see for the world economy? We saw above trend economic growth continuing as the world emerged from the pandemic. That was the outlook that we saw. The Russia invasion of Ukraine was an exogenous shock that disrupted everything. Of course, it's a humanitarian crisis first and foremost. Thousands of people killed, millions of refugees created, and so the human cost of that is not to be underestimated. But if we turn and look at it just from an economic perspective and from an investment perspective, it's been extremely disruptive. And we know what it's done to commodity prices. It's caused spikes in energy prices, agricultural commodity prices. It's disrupted trade flows and supply chains. It's added inflation to an environment that was already struggling with inflation. It's changed the outlook, as I said a minute ago, from one of above trend economic growth to one where recession has to be part of the consideration. The probability of recession has gone higher, and it's especially high in different parts of the world. Europe in particular, the recession risk there is quite acute. It's changed central bank policy. Central banks around the world, we all know, have moved aggressively to try to get in front of the inflation pressure. So whether it's the Federal Reserve, the European Central Bank, the Bank of Canada, the Reserve Bank of Australia, around the world, we're seeing the same playbook being utilized by the world's central banks. And this has, first and foremost, it has a bearing on what the interest rate outlook is likely to be as we look forward. So just to give you some data to support the view that we are looking at a world of slower growth and higher inflation, the top panel here comes from the OECD. And what I'd like for you to take away from this is if you look at the top line there, that's their outlook in December of 2021. Growth across the board, and those are very nice growth numbers, generally above trend growth. To say that the US, for example, would grow 3.7% in 2022, that's well above long-term trend growth for the US economy. The updated version in June, you can see that the growth projections have been taken down materially across the board. The lower panel here looks at what the Federal Reserve in the United States is projecting. So as you may know, each of the members of the Federal Open Market Committee over the course of the year will let people know what their expectations are. And then it's called the Summary of Economic Projections. And what we're summarizing here is the Summary of Economic Projections from the members of the Federal Open Market Committee around growth in GDP and around inflation. And the progression that I'm trying to illustrate here is December 2021, March 22, June 22. As you look at 2022 column there, you can see the ratcheting down in the growth expectation, 4%, 2.8%, 1.7%. At the same time, you can see how the view around inflation is growing increasingly concerning, 2.7, 4.1, 4.3. So the inflation that the Fed was saying was transitory looks not to be quite so transitory, and that thought is sinking in with the central bank. So the trajectory of interest rates we think is higher. This, as I said, was something we started to think about back in December. What I'm showing here on this chart is the sovereign bond yields for three benchmark government bonds. On the top is the 10-year US Treasury yield. The one in the middle is the 10-year UK gilt yield. And the bottom line is the 10-year German Bund yield. And we go back to the beginning of 2020, and you can see around the end of 2021, starting to inflect higher. There are bumps and wiggles along the way, as there always are, but I think you can see that the trajectory of those three lines is upward and to the right. It's even worth pointing out as well, if you look at the Bund rate in Germany, the 10-year government bond in Germany was negative for quite some time. It's well back into positive territory today. One more picture to illustrate what's going on with interest rates and interest rate expectations. I'm sure you're all familiar with the Fed's dot plot. Again, with each Fed meeting, the members of the Federal Open Market Committee lay out their expectations for where they think the Fed funds target rate is likely to be at the end of the period. And what I'm showing you here is the median of those dot plots. And I'm showing it to you going back to the September 2021 meeting. In the September 2021 FOMC meeting, the median expectation for the Fed funds target rate at the end of 2022 was 0.25%. Roll forward to the most recent meeting in June, and the expectation is for the Fed funds rate at the end of 2022 to be 3 3/8. So for the Fed and the members of the Federal Open Market Committee, the expectation about what they're going to have to do with the target rate to get inflation under control is raise rates and raise them pretty significantly. So this leads to the concept of duration. And as I said earlier, it's something that we've talked a lot about and done a fair amount of work in our shop. Duration is a concept that most people are familiar with on the fixed income side. It is normally something that people would say, well, that's a bond idea, duration. What does that have to do with stocks? Well, I would suggest that the idea of duration applies generally to any asset, and it's really all about what do the cash flows from that asset look like? How do they evolve and develop over time? And it turns out that you can make an argument that when you look at equities, the concept applies equally well. When you look at stocks, when you look at companies, it's important to have some understanding of how cash flows will evolve and develop over time. For some companies, for some stocks, the cash flows that are supporting the valuation of those stocks are cash flows that are out in future years. Those are long duration equities. The insight for us, and in particular application here that's important, is for the shareholder yield strategy, we're investing in companies that are generating cash flows today, sufficient cash flows today, that it can support attractive growing dividends today. So by definition, what we're investing in is shorter duration equities. Now, if you asked any investment grade bond manager, if you face rising interest rates, what's the first thing you do? And page 1 in the playbook says if rates are going up, shorten duration. Well, in this environment where rates are going higher, we think equity investors need to think about duration as well, and we think the shareholder yield strategy offers a shorter duration portfolio that should be resilient in the face of rising interest rates. I hate to do this to you, but here's an equation. I won't stay here long, but I just wanted to, the point I'd like to make with this equation, this is the present value of a stream of future cash flows, and the point is, this interest rate sensitivity, this idea that duration matters even for equities, it's in the math, and it's inescapable. And the math tells us is that those distant future cash flows will have a bigger impact on present value for a given change in interest rates. So the farther out in the future and the bigger the cash flow is, the bigger the impact on present value, the bigger the decline in present value for any given increase in rates. So I'll pass that and we can put that equation behind us. Now, rates are going higher, duration matters, longer duration stocks should be more vulnerable in that kind of environment. What I'm showing you here is a chart that looks at enterprise value to EBITDA multiples. So it's a metric that captures valuation. And I'm looking at the 3 different indexes here. The top line is the NASDAQ 100 index, and of course that captures many of the growth and tech stocks that people have been so fond of investing in recent years. And what you can see is you look at that top brown line, over the past 10 years, the trajectory has been higher. And in particular, when you see the period from about the middle towards the end of 2020, as the stock market started to recover from the pandemic in 2020, there was a significant increase in the valuation multiple for the NASDAQ 100 index. You can also see that increase in the valuation multiple for the MSCI World Index. That's the middle line, and even as well for the MSCI World High Dividend Index, and that's the bottom line. The degree is a little bit less as you go from the NASDAQ 100 to the MSCI World to the MSCI World High Dividend Index. But nevertheless, what I think is important to note now is we have seen over the first 6 months of this year a significant amount of, if you will, air coming out of the balloon. The NASDAQ 100 stocks that had seen a significant increase in valuation multiple, a significant stretching, if you will, of the multiple applied to those stocks, many of them have come back down to earth. And we have seen this correction take place, and it's been, in fact, to the advantage of our strategy. Our performance in the first 6 months of this year, it supports our notion that we should be more resilient in the face of rising interest rates, and indeed we have been much more resilient with very good relative performance and very good defensive characteristics. As I look at this chart, I think a couple of questions come to my mind, and maybe to yours as well. So we've seen, if you look at the NASDAQ 100, we've seen that multiple come down a lot. One question that comes immediately to mind is, are we done? Is this it? Has the valuation correction taken place, and is it over? As I look at that line, a couple of observations I'd share with you. It is still high relative to the MSCI World and relative to the MSCI World High Dividend Index, and it's high relative to its history. And I'd even put the question a little bit differently. Rather than saying, gee, does it fall further from here, maybe look at it this way. In the environment that we've described in the previous slides, slower growth, higher inflation, higher interest rates, tremendous uncertainty, is that an environment where you think multiples are likely to start expanding again? Is that a recipe for multiple expansion? I would argue probably not. Probably an environment where I think you might want to remain defensive, and that's where the shareholder yield strategy has its strongest appeal. So this is a busy chart. It is really important and really foundational for the firm, for Epoch Investment Partners, and for our investment philosophy. We've used this in presentations for years. It really has some eternal truths, if you will, that we'd like to share. What we're looking at here is returns in the US stock market, the Standard & Poor's 500 index, going all the way back to 1936. And over 10-year rolling periods, we've looked at the return for that index and broken it down into its three component parts: dividends, earnings growth, and PE multiple expansion or contraction. So the main takeaways here are, if you look at the brownish bars at the bottom, those are dividends. Dividends are always positive. Dividends are always a positive contributor to returns for equity investors. The lighter blue bars are earnings growth, and earnings growth is almost always a positive contributor to equity returns. As you look at that chart, if you look at it carefully, on the far left, you'll see an episode where some of those light blue bars are below the horizontal line. That's the Great Depression. And if you look to the far right, there's one lonely blue bar sticking down below the horizontal line. That's the global financial crisis. So barring those extraordinary events, earnings are a positive contributor. Well, what about PE multiples? They expand, they contract, and to be sure, for periods of time, even for years at a time, multiple expansion can be the primary driver of equity returns. But the longer your lens, the more you widen this lens historically and look at the longer term trajectory and history of stock market returns, what becomes apparent is multiple expansion and multiple contraction tends to wash out over time. And what you're left with is the two fundamental drivers of return: dividends and earnings growth. And that's what we focus on in particular for the shareholder yield strategy. Now, if the market environment is going to be about getting a return from dividends and earnings growth, one question that comes to mind is, will companies in a challenging environment be able to pay dividends, be able to grow dividends, be able to continue with shareholder distributions. This is a slide that shows for non-financial U.S. corporate businesses, going all the way back to 1950, the liquid assets on their balance sheets. And it's an extraordinary story that it tells, and you can see the growth in this number over the years, and in particular, in the period since the global financial crisis, so starting in 2009, you can see the tremendous acceleration in growth of non-financial corporate business liquid assets. We read all the time, we talk all the time about how in the post-GFC world, the central banks around the world have flooded the system with liquidity. Low interest rates, zero interest rates, negative interest rates, aggressive quantitative easing programs. This is one perspective on the liquidity that has been placed into the system. That number at the top is about $7 trillion. So there's certainly enough cash in the system, enough liquidity in non-financial corporate businesses for them to have the ability to continue to make shareholder distributions. That's a lot of cash. What might they do with it? Well, this is a chart from our friends at Goldman Sachs. They do this analysis. They've been doing it for a while. When we first saw it, we thought, well, this is right up our alley. At the very beginning, I showed you our 5 uses of cash model. This is their assessment of application of cash using that exact same framework. So that this chart, the bars in this chart, show the composition of cash usage across buybacks and dividends, cash reinvestment, which is capital expenditures and R&D spending, and M&A. And you can see, if you look at the dark blue bars at the bottom, they've consistently been a significant portion of the application of cash by businesses. But what we see in their estimation, in the estimation of Goldman Sachs' analysts, 2022 and 2023, an expansion of cash applied to dividends and share buybacks. 50% of cash going in that direction. So we think this is, again, setting up well as we look at this forward environment, as challenging as it may be, setting up well for our strategy, the Global Equity Shareholder Yield strategy. So this is a chart that I put together last week before I came down here to Australia, and I was trying to map out for myself what are the variables as I look at the outlook and the macro environment. What scenarios can I come up with for these different key variables? So left to right, I'm trying to understand what might happen, for example, with inflation. Is it possible that we see, with commodity prices rolling over, and we've seen some significant easing of pressure on commodity prices, is it possible that the worst of the inflation pressures are behind us? And we will start to see inflation start to trend lower from here, a very beneficial and helpful outcome. On the other hand, inflation could be stubbornly persistent. There's a view that once inflation starts to appear in services, which it has, it starts to become persistent. And once it starts to work its way into wages, again, there is a risk that inflation is much more persistent. We said a year ago, we thought it was transitory. We came to the realization, not so transitory. It may be stubbornly persistent yet. And then as you move to the right, it's like the box that you pick in column A influences the box you're likely to pick in column B. As I think about interest rates and what central banks might be doing, if inflation is starting to peak and has rolled over, that opens the door for the central banks to ease off. They don't need to raise rates quite so aggressively. Seems to be some of the thinking that's in the market lately, that perhaps the central banks, the Fed in particular, having raised rates by 75 basis points in June and 75 basis points in July, it's front-end loaded, and what we'll see from here is much more modest rate increases. Possible, but they could also continue to hike very aggressively. It's an active debate in the market today. Is the Fed close to being done? Are the other central banks around the world close to being done? Or have they really just begun a tightening cycle that's going to take place and continue for many quarters to come? That then flows into your assessment of, well, do we have a recession? Do we have a modest recession? Do we have a severe recession? Do we possibly still have a soft landing with no recession? All of those possible scenarios have to be recognized as having a positive probability. Oil is a key variable. We've seen oil prices go up well over $100 a barrel. We've seen oil prices come down more recently along with other commodity prices. If you look at oil over time, it is a mean reverting time series. Oil goes up and it comes down. The old saying is the cure for high oil prices is high oil prices. So there's a view that perhaps we've seen the worst of oil prices and that oil price pressures will start to ease. That would be helpful, that would be beneficial. There's also a view that if demand continues to grow, as the world emerges from recession, and maybe if we do avoid a recession and we have a soft landing, energy demand and oil demand is not going to go down. And there is a concern that maybe there's not as much excess capacity to produce oil around the world as we may think or hope there is. So the oil market could remain tight for some time. COVID is another one. Is the pandemic over? We hope so. We don't know. Might other strains emerge? Always possible. Even if strains that emerge are less dangerous, if you will, from a health perspective, there's still the economic consequence, if you will, of does China continue to stick stubbornly to its zero COVID policy, which would suggest that even with relatively mild strains popping up in different cities around China, that we continue to have supply chain issues as a result of COVID flare-ups. The geopolitics column could go on and on. Those risks are always with us, but just to illustrate some of the key risks that are on the horizon right now, how does the Ukraine-Russia war play out? Are we near an end? How does it end? What does an end look like? Does it drag on and continue to disrupt commodity prices, continue to disrupt supply chains? Possible. What happens with China and Taiwan? The US has midterm elections coming up in November. That is going to be pivotal. And of course, the Italian government just fell. They're forming a new government. What will the shape of that government look like? The UK is in the process of selecting a new prime minister. So there is geopolitical uncertainty all over the place. So as I take a step back and look at this, the main takeaway that I have for you is there's a tremendous amount of uncertainty right now. And this does not look to me like the right time for a risk-on trade. This looks like an environment where the smart move for investors is to try to be more defensive rather than not. And so just to maybe sum this all up, the macro environment we see is very challenging with a lot of uncertainty and a lot of things to worry about, and we think this sets up well and plays to the strengths of the shareholder yield strategy. As I pointed out a few minutes ago, when we think about the lens of duration, long duration equities versus short duration equities, the longer duration equities continue to, we believe, face headwinds for valuation, and it's unlikely to be an environment where multiples start to inflate again. Shareholder distributions are going to be really the key drivers of returns for equity investors, we believe, in this environment. So it's about dividends and it's about shareholder distributions and earnings. And we think that there's enough corporate cash and enough corporate liquidity and a willingness among corporate management teams that they will turn to those avenues to distribute cash back to the owners of the business. So we should continue to offer good absolute and relative returns, consistent returns, a high level of attractive income, lower the market volatility, good upside participation, good downside protection. That's the value proposition with shareholder yield. And as I go forward, I'll share with you some slides to further illustrate some of those attributes of shareholder yield. So first, just to wrap up a little bit or summarize a little bit the performance environment. What I'm showing here, this is the performance in the market. These are not the numbers for the strategy. This is what we all know, is what we've all lived through, and certainly in the past 6 months. You can see the MSCI World Value Index, the Core Index, the Growth Index, the High Dividend Index, and the Low Vol Index. Year to date, the pain has been in the Growth Index, and the resilience is evident in high dividend and lower volatility strategies. So here's shareholder yield. A busy slide with a lot of information, and maybe to walk you through it, as you look across the bottom panel there, that's year by year, the returns for the strategy relative to the benchmark index, the MSCI World X Australia. All the way back to the beginning of the strategy, year one in 2006, for 16 years. One year that maybe I would highlight and put a circle around for you is 2021. That's an indication of a year when the market moved ahead very aggressively. You see 29.3%. That's an exceptional year in stock markets. And the strategy on a net basis delivered a return of 25.5%. One might look at that and say, gee, you guys must be disappointed. You underperformed the index by 400 basis points. On the contrary, When we got to the end of 2021, our view on the shareholder yield team was that's about as good as it gets for us. That's terrific upside participation. It's almost 90% upside. And as we looked at our portfolio coming out of the pandemic year of 2020, we saw companies raising dividends by a material amount. We saw companies resuming share repurchase programs. Really good year for us. That's what you should expect from this strategy in an environment when the market's going up significantly. We'll talk a little bit more in a few slides about the downside protection that the strategy offers as well. If you look to the top left panel, what you see there is the quarter, year-to-date, 1 year, 3 year, 5 year history, and you can see year-to-date on a net basis, the strategy's down 3.2%. The benchmark index, on the other hand, is down 16.1%. So really good downside protection, which has been the history for the strategy. Only a couple things I maybe point your attention to in the upper right-hand panel. I've said a couple of times this is a strategy that has lower volatility, and you can see the standard deviation for the strategy is lower than the standard deviation for the index, and the Sharpe ratio also better for the strategy than the index. This is a slide that shows the fund's performance, so more relevant for you in this audience, and you can see the unhedged at the top, hedged at the bottom, and I won't go into the numbers here, but these are some of the numbers that are probably more relevant for you as investors in the fund. So let's take a look at the portfolio that we own in shareholder yield. These are the top 10 holdings. A couple of things that I would emphasize here. One, it's a highly diversified portfolio. We typically own about 100 stocks. We own 111, I believe, at the end of June. That means that there are no concentrated bets in the portfolio. We've really tried to build a diversified portfolio and reduce as much as possible the idiosyncratic risk of individual companies on the portfolio. So even the larger weights that you see there, 2.1%. We have a self-imposed limit. We will not own more than 2.5% in any given name, and honestly, we typically start to trim when a stock position appreciates above 2%. I'd also suggest that it's well diversified. It's diversified across sectors. You see healthcare companies, information technology companies, staples, energy. So diversified across sectors, diversified across geographies, the US, the UK, France, Germany, Switzerland. One other point that I would make here is you look at the dividend yield. With a dividend yield strategy, you might think top 10 holdings, those are probably the stocks with the 10 highest dividend yields. And that's not the case. The top 10 holdings are the ones for which we have the highest conviction around the company's ability to continue to generate cash flow, to grow cash flow, and continue to share some of that cash flow with the owners of the business through dividends, share buybacks, and debt reduction, shareholder yield. So you see dividend yields there as low as 0.9% for Microsoft. So as I think about the distribution of dividends in the portfolio, the average dividend yield on the portfolio today is 4%. I've got a slide to show you that the historical range of the dividend yield for its entire history has been about 4%. But at any given time, there's a distribution of dividend yield. So we're putting together a portfolio with companies that have different dividend yields in order to deliver an overall portfolio outcome of a dividend yield of about 4%. We're seeking to diversify the portfolio as much as possible to achieve that end. The last thing to talk about on this slide, you see on the right the tick marks as you go down the columns: stable or growing dividend, buying back shares, reducing debt. So it's important to understand as we think about managing this strategy, every stock that we own pays a dividend, and for every stock in the portfolio, we would tick that box: stable or growing dividend. Do we expect every company that we own to buy back shares every year? No. And likewise, do we expect companies in the portfolio to repay debt every year? And the answer to that is no. What we're looking for, and this goes all the way back to the beginning, we're looking for good capital allocators. We're looking for management teams that understand what they should be doing is investing to grow where they can earn a return above the cost of capital, and otherwise returning the cash to the owners of the business. If a business has a profitable use for cash, whether it's capital spending, R&D, an acquisition that strengthens one of the verticals of the business, a bolt-on acquisition, those are good applications of cash. And if it takes away from share buybacks, that's fine with us. Reducing debt is another one that I would say just one more word on. It's not about paying down debt to zero. We're not looking for companies to pay down debt year after year after year. What we're looking for is management teams that have made the right decision about the appropriate debt level, the appropriate amount of leverage for their business. And often the right amount of debt is not zero. But what we look for when we talk to management teams is for them to articulate, what is your leverage target? And if they say our leverage target is 2.5 times net debt to EBITDA, and we just made an acquisition that took our leverage up to 3.5 times, but our objective remains 2.5, and you can see us bring our debt down to that target over the next 12 to 18 months. That's the way we like to hear management teams talk about leverage and debt on their balance sheet. So what about sector weights and geography weights? And much the same theme will be apparent from what I have to say on this slide, which is to say it's a diversified portfolio across companies, across sectors, across geographic regions. It's a dividend strategy, it's an income strategy. The usual suspects perhaps would be, I know what I'm going to see. I'm going to see staples, I'm going to see utilities, I'm going to see telecom. And those stocks are present in the portfolio to be sure. But we've very deliberately and consciously tried to diversify the portfolio so that we have good sector exposure. Financials is the largest sector weight in the portfolio at the moment. Information technology is one of the larger sector weights that we have. Now, of course, information technology in the index is over 20%. So on a relative basis, we remain significantly underweight. And you can imagine that there are many information technology companies that won't work for our strategy. They don't pay a dividend. They may not have free cash flow. So they're outside of our investment opportunity set. But we have found information technology companies that work for us that have shareholder yield characteristics, and it's a significant weight in our portfolio. You also see healthcare up there as a significant weight in the portfolio. So again, consciously, deliberately diversified across sectors. So if you look at the right-hand side of this slide, you can see as well that it is across geographies and across regions, largely a developed market portfolio. Now, we do have the ability to invest in emerging markets. We invest in emerging markets from time to time. And I can tell you that today there are 3 emerging market stocks in the portfolio. Although, when I tell you who they are, you will see that they are like many other stocks in our portfolio, like most of the other stocks in our portfolio. Very large, very well established, household names, if you will. In Korea, we own Samsung Electronics, and in Taiwan, we own Taiwan Semiconductor. I'd also mention, you see China there. We do have a position in China. We own China Resources Gas. So we will, from time to time, have emerging market positions in the portfolio, but it tends, for the most part, to be a developed market portfolio. So on this page, sort of a summary, if you will. What are the attributes of the shareholder yield strategy from top to bottom? First and foremost, a significant portion of the return comes from shareholder yield, dividends, share buybacks, debt reduction. Another key attribute and characteristic is abundant income. The company has an average dividend target of 4.5%. The history has been around 4%. It's 4% today. So sustainable and persistent dividend growth and dividend income. That plays into the defensive characteristics. Less than market volatility, strong downside protection. That has a lot to do with the dividend paying nature of the companies in the portfolio. If you think about investing according to factors, this is a strategy which gives you strong exposure to the yield factor with a tilt to value. Another way to think about the strategy that's an attribute that's important is it's a portfolio diversifier. It's a strategy that's a little bit different, and it correlates, or it has a low correlation with lots of other strategies, so it fits well in a portfolio allocation model. Style consistency, and you can see it in the factor attributes. We do what we do. We don't change what we do. We've been doing it the same way for 16 years, and you can count on us to continue to do shareholder yield the same way going forward. So a bit of a proof statement. So you invest in companies that pay dividends and have growing dividends. Why is that a winning strategy? Well, on the left, you can see here, these are compound returns for the MSCI World Index going back almost 25 years. And what you can see is the highest returns are for companies with growing dividends. Better returns for growing dividends than stable dividends, better than zero dividends, and not too surprisingly, better than dividend cutters. So you get better returns with growing dividend companies. In addition, if you look at the right-hand side of this slide, that's the volatility, the annual standard deviation. Again, along those same lines, the lowest volatility is for companies with growing dividends. So that should be, over time, a winning combination and an appropriate way to generate wealth, to preserve wealth over time. Invest in companies with growing dividends. It should deliver higher returns and lower variability of returns. Now, what I'm showing you here, this is the track record, if you will, a proof statement that we continue and have historically been able to find companies for this strategy in a variety of economic environments over the years that raise their dividends. So this is the number of companies in the portfolio each year that raise their dividend, and the percentage number that you see below it is the average increase in dividend that year. Year by year by year, if you think of the portfolio as holding about 100 stocks, give or take, and it's on average it's been about 100, the one way you might summarize this is to say, in any given year, 2/3 to 3/4 or even more of the stocks in the portfolio will be raising their dividends by a mid-single digit amount. I would draw your attention just to make the point at 2020. 2020, of course, the pandemic hits, very sharp, very sudden, historical recession globally. A lot of conversation in 2020, would companies be able to pay dividends? Would companies be able to continue with their shareholder distribution practices? The impact was so profound that there was a lot of concern that it would have to be curtailed broadly across the board. We did a webinar in April of 2020, and we titled it, "The Death of Dividends Greatly Exaggerated." We acknowledge that many businesses and many sectors would be so profoundly affected that they would have no choice but to cut their dividends and eliminate their shareholder distributions. We didn't deny that, but the argument we made was that there would be other companies in other sectors who over time, in the course of 2020, would actually generate the cash flow that it would allow them to maintain their dividends and even grow their dividends, and we'd even find companies that could continue with their share repurchase programs in 2020. Here's the track record. In 2020, 67 companies in this portfolio raised their dividends. I think that's extraordinary. And the average dividend increase was 5.4%. So a very good track record and a proof statement that even in a really challenging environment, we continue to find companies that have the shareholder yield characteristics that we seek. So far this year, 58 companies have raised the dividend in the portfolio. I've said a couple of times it's a strategy that has a consistently high dividend yield. This is the history of the strategy back to the beginning. And you can see it goes up and it goes down, but it's always around 4%, and it's just exactly 4% today. The line below that is the aggregate bond index, and it can give you a sense of how the dividend yield from a diversified portfolio of high-quality stocks can offer an income that's competitive with and indeed superior to what you can get from an investment-grade bond index. Downside protection. This is one of the most important features of the strategy, and certainly one of the most relevant ones to be thinking about in the environment that we see, the challenging environment we see. We've looked at the strategy, the history of the strategy. This is real data. This is not back-testing hypothetical data. The strategy is 16 years old. So we took a look backward and said, over the 16 years that this strategy has existed, how has it done when the market goes down? And when the market was negative for a rolling 3-month period, the strategy outperforms 75% of the time by an average of about 4.3%. I wish I could tell you that it outperforms every single day. Pick a day, any day, the market's down, we'll outperform. That's not the case. That's probably not a realistic way to think about it. But what I can say is 75% of the time when the market goes down, we outperform. And more significantly, when you look to the right, we've done the analysis and said, well, how does the strategy do when the market is down significantly? What if we have a drawdown of at least 5% over a 3-month period? In that difficult scenario, how does this strategy do? And the history says it outperforms 86% of the time by an average of almost 5.5%. So the downside protection with this strategy is enduring, it's stable, it's been there from the beginning, and it's something that is really critically important to think about in this environment today. Again, if you want to think about the strategy from a factor perspective, this is a Style Analytics skyline. And what you see there, if you're familiar with these, you'll know what this is. The bars, or the boxes rather, are the peer group. So this compares the shareholder yield strategy, the little gold box, with the peer group and relative to the MSCI World Index. And when you look from left to right, the value characteristics, earnings yield, cash flow yield, you see we're top quartile, so there's a clear value tilt with this strategy. On the dividend yield factor, our little yellow box is above the top. So that means we're an outlier in the top 5% with that peer group. When you look at the purple boxes, those are the quality variables, return on equity and net profit margin. The way I would suggest you would interpret that is it's median. So there's no clear tilt either way in quality, which is to say we've achieved a very high dividend yield factor exposure without sacrificing quality. And finally, the red box on the right, strategy has a market beta of about 0.8, and as we said, a lower standard deviation, and this plays into the variability and volatility. And in that case, bottom quartile is where we'd like to be, and that's where we are. We came up with this chart recently. I love it. I think it's one of the best charts we've ever come up with. For those of you that are familiar, perhaps, with American college football, maybe not too many in this audience, there's a legendary football coach, Paul Bear Bryant. He coached the University of Alabama for 25 years. He led the Alabama team to 6 national championships. He's the most winning coach in American college football history. And one of his famous sayings was, defense wins championships. And that's the way we think about shareholder yield. It may not be the strategy that outperforms during a period of time when the market is focused on growth and momentum, but over time, defense wins championships. The top chart on this page shows cumulative returns starting in 2005 when the strategy was launched. And what it shows is that $1 invested in shareholder yield at inception has consistently outpaced the benchmark over the strategy's life. This cumulative outperformance is the result of the resilience and the protection in down markets and the participation in up markets. The bottom panel of this chart is downside capture. You may be familiar with that. It's another way of thinking about the downside protection that I just showed you in the previous slide. What we're looking at here is the percentage of the downside that the strategy captures in significant plus 5% drawdowns. And when you think about downside capture, smaller is better. For example, if the market's down 8%, you'd like to be down 2%. So what we see in that chart there is good downside capture numbers in those significant drawdowns. And just not to make a promise, because it's not a realistic promise, but what I would tell you is if you look all the way to the right, those bars that are below the horizontal line, that means that our strategy went up when the market went down. And all we've done here, so if you take this top chart and you just zero in on the year-to-date 2022 period to highlight and really put under a magnifying glass, how is the strategy doing so far this year? And you can see clearly here that the downside protection is very much evident and doing a tremendous job of protecting wealth for shareholders. And I'll stop there. And here I've got a slide that just gives you a little sort of ad for Epoch Investment Partners. I appreciate your time today. It's been an opportunity for me to come down to Australia and speak to some people, and it's wonderful to be here again. I hope you found this presentation interesting and worthwhile. I hope you'll give us some more thought. If you'd like to go to our website, we've got white papers. There's a tremendous amount of information there. I'd encourage you to take a look at our website and see the information that's there. So thank you very much. I appreciate it, and look forward to coming back to Australia next year. I'll see you then.